What is in the best interest of shareholders? Well, that question was a hot topic of debate today, thanks to a strong warning from Larry Fink, the CEO of BlackRock. That's the giant investment firm. He sent a letter to all the CEOs of the S&P 500 warning that the recent trend of issuing dividends and stock buybacks under pressure from activist investors jeopardizes a company's long-term growth. Here's what he wrote. Many commentators lament the short-term demands of the capital markets. We share those concerns and believe it is part of our collective role as actors in the global capital markets to challenge that trend. Fink did not mention any specific activist hedge funds, but pointed out that big companies have become vulnerable to short-term thinking.
So does focusing on short-term gains jeopardize a company's long-term growth? We have two different views on the topic. Don Steinbrugge is a managing director at Agecroft Partners, a hedge fund consulting firm. And Bill George is the former CEO of Medtronic and professor of management practice at Harvard Business School. He's been on many, including many of the most prestigious boards in the country. Bill, with that in mind, let me begin with you. Mr. Icahn, among other activists, is very critical of corporate boards, says they misuse shareholder capital, and that the managements and the boards aren't acting in the best interests of shareholders. I assume you would say that has not been your experience at all.
Not at all. And in fact, Carl Icahn is going after eBay right now, and eBay's had a 465% return to shareholders in the last 5 years, Tyler. And you know, he's attacking some of America's best companies. Yes, corporations need to make sound capital decisions. They need to decide how much for growth, how much for acquisitions, how much they're going to return to shareholders on dividends. These are capital structure questions. I think they're sound. We got too far that way back in 2008, and that led to the financial crisis. The banks didn't have enough capital to keep them going. So I think the Carl Icahns of the world, you see Nelson Peltz trying to do the same thing with a great company like PepsiCo, break them up, try to get a short-term hit. Carl's just looking for a short-term hit. He's not concerned about the long-term growth of eBay. And I'll tell you, with the moves that Google and Facebook are making, unless eBay continues under John Donahoe to continue to invest and build their platform with PayPal and other aspects, they're not going to be as competitive in the global market. And that's what we in America need. Great global companies going after the global market, like PepsiCo is doing, like Coca-Cola is doing. I think that's really critical, that we're investing in our long-term future growth. And yes, we want to give fair dividends back to our shareholders. If we have excess cash, I'm on the board of Exxon. Exxon, it generates a lot of cash, and they have good shareholder return policies. But unless you have a lot of excess cash, I don't think you should be giving it all back to shareholders. I think you should be investing for the growth of the company.
All right, so let's get Don into this conversation. I know you're on the other side of this debate. Make a case of why people like activist investors like Carl Icahn or Nelson Peltz or Dan Loeb are working on behalf of shareholders and for the best interests of the company.
Well, first of all, I do disagree. I think in general, corporate management are more focused on doing what's good for the corporation as a whole than shareholders as a whole. And I think activists are checks and balances on corporate management. You know, if they return money to stockholders, who's benefiting? It's benefiting It's benefiting the economy because that money is then redeployed into private equity, venture capital, new businesses, and so forth. So if a company isn't efficiently utilizing their assets, someone else should more efficiently invest those. And without activists, there's no checks and balances on corporate management to do that.
So, Don, do you think the real criticism here is that the activists act for short-term purposes, i.e. to return capital, in some cases, to their own pockets in the form of stock buybacks or dividends, and that it might not be in the best long-term interest of the shareholders, and that's what Larry Fink was driving at. Address that specifically, if you wouldn't.
Well, you know, Larry Fink is, a lot of his assets are in an S&P 500 index fund, and he's looking at it very long-term oriented from an individual company. What he's not thinking about is from an investor standpoint. An investor wants to allocate his money into securities that are going to generate the highest return possible, and our economy benefits from that. You want money coming out of less efficient companies and going into more efficient companies. So the overall economy benefits when money leaves inefficient companies and goes into more efficient companies. Larry's opinion was, I'm an S&P 500 investor. I have to hold this company long term. Long term, maybe this doesn't benefit the company.
Okay. Bill, in half a minute.
Can I just comment on that, Tyler? I think that if they are inefficient and they're not managing capital well, I think the point is very well taken. I think they should be challenged. But when you go after America's best companies that are looking for long-term growth and you ask them to play the short-term game, that doesn't help anyone. And I like Warren Buffett's statement. He says, I think that management and his board ought to run the companies where the shareholders are going to stay, not those that are going to leave.
We have to end it there, Bill George.
Takes into account the best long-term interests of the corporation.
And Bill George, we have to end it there. We lost the satellite. Don Steinberger, thank you very much at Agecroft Partners. And Bill is with Harvard Business School.